dentists. So a bit of background about Money for Dentists then. They are expert independent advisors in the financial services sector exclusively to dentists and have been doing this since around the 1990s. Money for Dentists, they're also a multi-award winning market leaders in their profession as well. We've got two people coming up to speak for Money for Dentists today. Yep, we've got Sarah Smith and also Hever. So, let's come up.
Morning everyone, delighted to be here today. My name is Kevin Hever, representing Money for Dentists. Money for Dentists, as has just been said, we're expert independent financial advisors for dentists and their partners. We only deal with dentists, as the name might suggest. As a practice, we regularly write in publications and we exhibit at all the major shows, so you'll have seen us at the BDTA, the BDA show, as well as doing lectures at places like this. And what we aim to do is work with you throughout your career to support you with all your financial needs. So as you progress right from BDP through to owning your own practice, we aim to be there to help you as life changes due to personal events. The agenda for today, we're going to talk about choosing a financial advisor and more information on Money for Dentists, protection, making sure that you've got the right protection, retirement planning, finance and lending, and tax planning and savings advice. Right, some things to know when choosing the right financial advisor. There's basically three types of financial advisor. You've got a tied advisor who may work just with one bank or one insurance company, and they can only recommend products from that particular bank or insurance company. You've got multi-tied, where there might be a link up with 5 or so different financial companies, and they can recommend products and services from those 5 companies. Or you've got independent financial advisors who can advise you on anything that's out there, basically, that whole of the market. I'm happy to say that we come in that latter category, so we can advise you on anything that's out there. We work very closely with the main dental providers to make sure that their offerings are suitable for you guys. So we quite often consult with insurance companies and banks and make sure that their offering is exactly what you want, because we're in that market, we know what your needs are at different stages of your career. The independent financial advisor's role is different to your accountant's role in so much as we're more proactive. We look at whereas your accountant will react to the information that you give them, we're able to be more proactive, forward-looking, and see things that are coming up and make changes to your plans to take the latest legislation into account. If you need specialist advice in areas that aren't in our field, we've got other companies that are part of the For Dentist group, so we can also recommend lawyers and accountants. Which brings me on nicely to why to choose a financial advisor that specialises. We're proud members of the Association of Specialist Providers to Dentists. Membership of ASPD is more than just a signature, and it's by recommendation only. Each member has a unique quality that they're confident that they can make an offering to you. So we've been in ASPD since 2004, and we're proud of that. We've also won awards in the financial services industry from the Money Marketing paper, and we've won Small Mortgage IFA of the Year from Money Marketing as well. So moving on to income protection. For self-employed dentists, it's probably the most important financial product that you can have. It's essentially your sick pay if you're self-employed. Lots of dentists do have income protection, so it's very important to make sure that it does the right job for you, because there's some companies out there that have got very, that don't pay out very often, basically, in the event of a claim. And the reason for that is the definition of the policies. We always recommend that an income protection plan that you take out is based on your own occupation. That means it will pay out if you can't do your job as a dentist. I mean, that would sound like the ideal thing if you're protecting your income and you can't do your job, that it will pay out. But out in the market, there's different definitions. You've got suited occupation, which means you could be forced to do related jobs such as lecturing, which obviously wouldn't be very good. Or any occupation. That means if you can't be a dentist, they won't pay out unless if they think that you can do another job, whatever that may be. So in looking at that, you'd have to be very ill before you're not able to perform any job that's out there. So that's why the importance of making sure that you're covered for your own occupation. Because you spend ages learning how to be a dentist. If you can't be a dentist, your income protection should pay out. For those of you in the room who don't have income protection, we've developed a bespoke and unique way of covering your income. And because we're independent and specialists, we're able to offer this best protection for you. So there's financial advisors out there now who are copying the way that we do this. So I mean, I suppose that's quite flattering. One of the most important things to consider as you're self-employed is getting yourself covered from day one. And there are companies out there that will do that. So, moving forward, the most you'll ever need to claim for is just a few days off sick. If you have to have a few days off with flu or something like that, that you'll be able to claim for that. And there's ways of setting up your income protection that you can do that. For medium-term claims that can put you out for 6 to 10 weeks, you need to make sure that the income protection is set up that it covers you for the correct salary throughout your claim. So we make sure that it runs until your retirement age. And if you are lucky enough to get any sort of sick pay from your employer or whoever, we can factor that into the calculations when we're setting it up. Does anyone have any questions about income protection at this stage? If anyone's interested in that, in us talking to us about income protection, on the feedback sheet, just mention it and we can talk later. Life and critical illness cover. I mean, life cover is pretty obvious. It covers you if you die, it pays out. And if it's written under the correct trust, it can be paid out tax-free. So that can be used to cover debts such as your mortgage, or just to provide ongoing cover for your family if you've got small children or other debts that need covering. The premiums for it are based on age and medical history, and the medical history of your immediate family. So we see clients who wait until they're buying a home or purchasing a practice to actually look at this type of cover, whereas really you should look at dealing with it whilst you're young, fit, and so hopefully your parents are still in good health as well. Critical illness cover, is, again, that's a lump sum that pays out if you're diagnosed with a specific illness. There's other considerations when looking at taking out your critical illness cover, because part of it is total permanent disability. So if you can't perform your job, it will pay out. Now, there's a lot of companies out there that don't actually cover dentists as an own occupation under critical illness, and there's more companies than you'd think. So it never ceases to surprise me how many dentists have critical illness cover, but if they couldn't be a dentist, it wouldn't actually pay out under that particular clause of the critical illness. So again, if that's something you want to have a look at, please talk to us. And the other thing to think about is when you're taking out critical illness cover is whether to have a reviewable or a guaranteed premium. Now, a reviewable premium is reviewed every 5 years by the insurance company. It starts off a little bit lower at the start, but you don't know where it's going to end up over the term of the plan that you're taking. We tend to go for guaranteed premiums right from the start, so whilst you might pay a little bit more at the start, you know that it's not going to increase at all over the term of the plan. Okay, moving on to the NHS pension. There's a few questions that we always ask when we go out to see customers. Have you joined? How much you're paying in? When you'll get it, how much you'll get? And when did you join? And what the difference between the old and the new schemes is. There's a lot of questions about the NHS scheme, and basically this is something that we can analyse for you when we come to see you. We can write off to the NHS scheme, find out all the details in connection with it, and come back to you and give you a detailed analysis of your retirement provision. The scheme provides an automatic tax-free lump sum on retirement, usually 3 times your pension, and you have the option to increase the tax-free lump sum by giving up some of your pension when you actually get to retirement age. During your service, you'll have life insurance of 2 years pensionable pay whilst you're working. If you die, the pension for your spouse or partner, and that includes civil partners, allowances are also payable for dependent children. If you have to leave work after 2 years through ill health, there's enhanced benefits from the NHS pension, and you also have the option to increase by paying additional contributions. Apart from the NHS pension, you're probably aware that if you just rely on the NHS pension, it won't deliver the sort of retirement that you need. So you may be looking at other avenues. So we also can talk to you about personal pensions. Basically, they're becoming more popular than they were, say, 5 or 6 years ago, because the government had a big shake-up of them, which was called pension simplification in 2006. They've since gone on to make it a hell of a lot more complicated since then, but we're here to advise you. The charges for personal pensions have come down a lot since the 80s and 90s, so if you have got an old pension plan that you've built up funds in the past, it's worth looking to see if you can reduce the amount of expense that's coming out of that particular fund. Other things that you can do with a personal pension is you can actually use it to purchase commercial property. So it's possible to use a personal pension to purchase your own practice. That will obviously give tax planning advantages because it's within the pension wrapper. Also, it can also provide, it could be useful for your exit strategy as well, as it can provide you with an income in retirement. Pension legislation is always changing, so within this last year now, they've changed the amount that you can actually pay into a pension. So it's a maximum of 50,000 a year, whereas you used to be able to pay, I think it was 245,000 the previous year, and that's up to a lifetime allowance of 1.8 million. There are opportunities at the moment to use pension contributions that you haven't used in previous years by carrying it forward to this present year, which, you know, depending on your tax status, if you're 40–50% taxpayer, that could be very advantageous, because obviously for every £1,000 you put into a pension, if you're a 50% taxpayer, you get another £500 in tax relief. The other thing is, if you're an earner above 100,000, you'll be aware that your tax-free allowances have been reduced from April this year. Making a pension contribution could actually get you that back. So if you are in that category, for every pound that you're paying in, you could be getting up to 60% tax relief when it's all taken in together. So that might be worth considering as well. Has anyone got any questions about any of that? I'll thank you very much, and I'll pass over to Sarah.
Thank you, Kevin. So, moving on, what I'd like to discuss first with you is residential finances and mortgages. So, many of you in the room may have already bought your own home, but for those who haven't, if we just start with basics, there are going to be two main ways of you repaying your mortgage. That's going to be either by interest only or capital and interest. Interest only is where you pay just interest to the lender, and if you take out investments such as an endowment policy or an ISA to repay the whole loan at the end of the term. You could even use your pension lump sum if you wanted to. Capital and interest is where you pay back both capital and interest over the agreed period, so the loan is guaranteed to be paid back at the end of the term, assuming of course you have made all of your payments. It's also possible to do a mixture of the two. Now there are three main types of rate: fixed, variable and tracker. Fixed rates are, as they say on the tin really, your payment's going to be fixed for the next 2, 3 or 5 years. Variable rates are where the rate is set by the lender and can vary at their discretion, but it's usually going to follow the Bank of England base rates. Now these are great if you think rates are going to fall. Tracker rates do in fact follow the Bank of England base rate by a fixed percentage above it. So the rate is set monthly, and you've potentially got 12 changes in a year there, but base rate's been stable now for over 2 years at 0.5%, so they have been a very good deal. So what rates are on offer today? Well, we've got fixed rates currently starting at about 2.88%, and if you're looking at trackers, you've got 1.59% going up from there. If any of you are looking at sort of remortgaging or buying a house, please do come and speak to either myself or Kevin in your breaks, and we'll be able to help you. In terms of loan to values available, well, residential mortgages, it is officially still 90%, but there are ways and means of getting that 100% if you do need to. If you're looking at buy-to-lets or UK investment properties, you're looking at about 80–85% loan to value at the moment. If you're going for an overseas mortgage, which you can either get in sterling or the local currency, depending on where you're looking at buying, you're looking at about 50–80%, depending on the country. But again, come to speak to us if you've got any countries or properties in mind, and we'll be able to tell you what's available there. One of our unique benefits is that even in the current mortgage market, we can arrange those full status mortgages for those of you that have been self-employed for weeks and months rather than years. We often find that people go to their banks and say, oh, I haven't got my 3 years account, I can't get a mortgage. It's not true, particularly for the dentist. We're still able to get that even if you've only got a few months of sort of associate schedules. So again, if you're in that situation, please come and speak to us because we can help. Offset mortgages. Many in the room may already have one or may have heard them. These are great for the self-employed and the higher rate taxpayers. In essence, you're only going to pay interest on the net balance of your mortgage, and as you're technically not earning any interest on your savings, you can't be taxed on it. To give you an example of this, say you've got a mortgage of about 300,000 and the interest rate you're paying is 3.44%. if you put 50,000 in savings in an offset savings account, you'd effectively only be paying 2.87% on that mortgage. What you can then do is choose to either reduce your mortgage payment accordingly or pay back your mortgage early due to your overpayments. Some lenders are going to allow you to offset up to 12 different accounts, so they can be anything from your current accounts, your future tax bill savings, your holiday funds, your cash ISAs. So it's still possible to get instant access to your money, keeping it separate but helping it work for you in terms of getting that mortgage paid back earlier or a cheaper monthly payment. My next slide was going to be all about practice finance, but as Ray has so expertly gone through that one with you this morning, I won't let you go through it in a second slide. So we will move on to tax planning. There are three main types of tax you'll pay in your lifetime, and with careful planning, all of these can be reduced or eliminated. So we've got income tax payable on your income, either under PAYE or via self-assessment. Capital gains on your capital growth, there's very little you can make a profit on in this country and not pay tax on. And inheritance tax payable on your estate when you die, which can be greatly reduced with careful estate planning. So ways to reduce tax. Well, these can be your traditional tax-efficient savings, such as ISAs, premium bonds, tax-exempt savings plans, to a perfect vehicle for tax planning with no upper limit on what can be invested. The proceeds from this are paid out tax-free, and that can be very useful when considering your exit strategy. Individual savings accounts or ISAs, your limit now is 10,680, so that can be 5340 in cash or stocks and shares, or the full 10,680 in stocks and shares. You can also save regularly over a 12-month period into those. It is really important to shop around for your cash ISAs, as the best rates only tend to last for 12 months. So if you are going to move it on those 12-month periods, do make sure you do it with the actual provider. They don't actually transfer it yourself, because you could end up losing your tax efficient status. Your cash ISAs, they're great for your emergency funds, but growth in the long time is often going to be eroded by inflation. So if you are looking for sort of medium, long-term investments, we would suggest you look at stocks and shares ISA. Now, it's essential really to get independent advice when you're looking at stocks and shares, because there are thousands of funds, they need to be analysed for performance, charges, and a portfolio created which is going to match your attitude to risk. Luckily, we research these on a daily basis, so again, it's something we can help you with. Utilising your full ISA allowance can build you a nice nest egg for the future. If you invest the maximum every year of a 30-year career, you'll have built up at least 320,000 in a fund, taking into account no investment growth. So, and that's going to mature with no further tax liability, so it is a great way of saving. Another way to potentially reduce your tax liability is to use a specialist accountant. As they specialise in the tax side of dentistry, they'll be aware of what tax rates are available to dentists and have a full understanding of what HMRC will and won't accept in terms of your expenses. Estate planning, that's also important. How many people here have got a valid will? Well, the benefits of those, they're huge. They help mitigate inheritance tax. They make life simpler for your family at a really difficult time. They ensure you have chosen who you want to benefit in the event of your death and in what proportions. They're going to clear up any confusion for unmarried homeowners, and they appoint a legal guardian for your children. If you don't have a will, ultimately your money and property will end up going to the Crown. Is that what you really want? Just one other point to remember in this as well is that both marriage and divorce do in fact invalidate your will, so if you have recently been through either, you do need to relook at it. Our aim here is to enable you to be financially independent at an age of your choice, not just through pensions, but flexible investments using your tax-efficient allowances, or being mindful of the tax treatment at all stages of your lifetime. We work closely with yourself and your family to ensure you meet the aims and objectives in the most tax-efficient manner. And finally, did you know, income tax is voluntary. We have access to many interesting initiatives, one of which will limit the amount of stamp duty you pay when buying your next property, and another that will in fact eliminate your tax liability for both the current and previous tax years. In essence, you'll not need to make a payment to HMRC in January or for the next 2 instalments after that. It's important to say that it follows government legislation rather than loopholes, and it has been validated in the High Court. There are certain criteria you do need to meet in order to comply with guidelines on that, but many of you in the room are going to fit the profile. So what's in this for you? Well, what we're offering today, all delegates of the show, is a financial review with one of our advisors to go through a full analysis of your current programme and guidance and show you how we could make or save you some money. In order to claim that review, you've all got feedback sheets on your chairs today. Please can I ask that you fill them out, including all full contact details, and one of our advisors will be in touch next week to make that easy. Both Kevin and myself will be around for the rest of the day, so if anybody's got any questions on anything we've covered, please be coming up to them. Thank you for your time.
So next up we have Chris Hindle, who's come from Cohen Kramer. It's a specialist firm of solicitors who advise dentists specifically on all aspects of the business.